I told you the balance in your bank account isn't money? It looks like money, it feels like money, but it's not. It's credit, a digital IOU from a system drowning in debt, addicted to growth and convinced it can print its way out of every problem. We live in a world where the very act of saving is punished, where inflation is a feature, not a bug, where governments ask for your trust while simultaneously debasing the thing you're trusting them with. Now ask yourself, if everything you own sits inside this system, what happens when the system breaks? Let's start with definitions. Currency is a medium of exchange. Paper, pixels. It moves around, helps us trade and pays for things. Money, on the other hand, it is a store of value. It survives time. It preserves purchasing power. It isn't someone else's promise. Gold is money. The euro is currency. The dollar is interpretive. Most people don't have money. They have currency created by someone else, managed by someone else, and devalued by someone else. Inflation is the silent thief that never knocks. Your salary doesn't stretch like it used to. A full tank of petrol now costs more than a dinner out. Grocery bills spike while your wage growth is celebrated at 3%. In the US, eggs doubled in price. In the UK, grocery prices rose nearly 20% in a single year. Politicians blamed supply chains. Economists blamed demand. No one blamed the money printer. But this isn't a malfunction. It's a system doing exactly what it was designed to do, slowly shaving down your time, your labor, your effort, like the monetary policy equivalent of termites. And the system itself, that's the real risk. Global debt now sits north of 300 trillion. Bank failures are no longer historical anecdotes. They're real-time events. SVB collapsed in 48 hours. Credit Suisse folded under pressure. Central banks have gone from decades of suppressing rates to panic tightening, with all the grace of a drunk driver yanking the wheel. Meanwhile, delinquency levels on credit cards and used auto loans in the US have surpassed their 2008 highs. Consumer credit is ballooning, with over 550 million active credit cards circulating in the US alone. Non-bank financial institutions, those charming acronyms like NBFIs, now hold nearly half the world's financial assets, largely unregulated and mostly opaque. Cybersecurity incidents targeting banks and credit unions have become routine. Your money is safe is a promise increasingly vulnerable to a power cut or a phishing link. It gets worse. The European Banking Authority's 2025 stress test includes a scenario with a 6.3% GDP drop over 3 years, complete with geopolitical shocks, energy price spikes, and cascading sector failures. The ECB's supervisory priorities now include resilience against macro financial shocks, credit risk framework improvements, and perhaps most ironically, managing the risks created by digital banking itself. And just over the horizon, we have central bank digital currencies, pitched as innovation, but designed for control, programmable money, expiration dates, spending restrictions. In a crisis, a CBDC can be stimulus, rationing, and surveillance rolled into one tiny line of code. It's not a conspiracy theory, it's the public policy papers. The same institutions that didn't see 2008 coming and stumbled through 2023 now want direct influence over how, when, and where your money moves. Gold, by contrast, doesn't come with a backdoor. It doesn't expire. It doesn't need firmware updates or compliance patches. All of which brings us to a more personal question. How safe is your money really? Deposit insurance has limits. In the US, the FDIC covers up to $250,000. In the EU, it's 100,000 euros. Got more than that in one account? Congratulations, you're uninsured. Even insured deposits aren't magic. If a bank collapses, you don't get an instant refund with a cheerful emoji. It takes time. And time is the one thing that people just don't have in a banking panic. Smaller banks are especially fragile, often built on undiversified loan books. One sector takes a hit, used car buyers default, say, and the whole structure folds before most depositors can even log in. But even if your bank is safe, it may still fail because another one wasn't. Interbank lending is a confidence game. When confidence dies, so does liquidity. And that is how dominoes fall. When the system breaks, it doesn't announce itself. It just stops working. One day, your card declines for security reasons. Your bank app gives you a service unavailable message. Your funds are under review. Capital controls aren't just Greece or Argentina. Canada froze bank accounts during protests. Cyprus raided depositors. The idea that your money is yours becomes a polite fiction, one that evaporates under pressure. Gold doesn't lock up. It doesn't need a network. It doesn't care what side of a protest line you're on. The new financial giants, the NBFIs, hold enormous systemic risk without the guardrails. If one goes down, it doesn't just cause internal losses, it sends shockwaves into adjacent institutions, often banks, while you're still waiting for a 2FA code to check your balance. Then there are the geopolitical wildcards, wars, sanctions, broken trade links. These don't just move markets, they disrupt the very plumbing behind your debit card and your paycheck. But gold? Well, gold doesn't have these problems. It doesn't freeze, default, or rely on capital buffers. It just exists. Gold doesn't default. It doesn't dilute. It doesn't depend on politics or PR. It's not someone else's liability. That's why central banks keep buying thousands of tons of it, not because they like shiny things, but because they're quietly hedging against the system that they helped build. China reports only part of its holdings. Turkey and India have been stacking. These aren't investment strategies, they're insurance policies. Gold has quietly become the plan B that no government will publicly admit to having. Meanwhile, asset values in fiat terms continue to rise, not because assets are gaining value, but because the measuring stick is shrinking. Gold doesn't play that game. A gallon of gas costs roughly the same as gold today as it did 50 years ago. So does a suit. Gold is the economic polygraph, and the system doesn't like what it says. History has a pattern, and it doesn't favor fiat. Rome clipped its coins into worthlessness. Weimar Germany printed itself into hyperinflation and societal collapse. In 1971, Nixon severed the last tie between the dollar and gold, not with a vote, but with a Sunday evening TV address. And just like that, the US defaulted on gold convertibility. The dollar survived, but its credibility became a function of narrative, not substance. Every fiat currency in history has either collapsed, been restructured, or inflated away. Gold, on the other hand, is still here, still trusted, still beyond political reach. Buying gold isn't about getting rich. It's not about being poor later. It's not an investment, it's an exit, a way to take part of your wealth out of the system, away from banks, brokers, and bureaucrats. You do not need a 400-ounce bar like the central banks. So if you have one, congratulations. You've exited more than just finance. But if you're going to buy gold, do it intelligently. Divisibility matters. You don't want a bar that you can't break. 1-ounce coins or fractional pieces give you options. Authenticity is critical. Buy from reputable dealers like GoldCore. Look for serial numbers, LBMA memberships, stamps, tamper-proof packaging. Recognizable helps when you need to sell. Britannia's, Eagles, Maples, Pamp, Swiss. If your dealer has to Google it, walk away. Economic efficiency matters too. Larger bars may have lower premiums, but in a crisis, flexibility and divisibility is worth more. And then there's storage. Vaults are ideal. Safes work, but if you're nervous about bank access during a temporary disruption, maybe skip the safety deposit box. And please do not confuse ETFs for real gold. They're not. They're paper proxies, unallocated, pooled, and custodian dependent. If you can buy or sell it with a click, it ain't a hedge. It's a convenience and it's counterparty risk. In many parts of the world, gold isn't exotic. It's normal. In Vietnam, gold bars and rings are used as saving tools and collateral. In Turkey, banks issue gold-backed checks. Indonesia has gold pawn shops and even blockchain-based savings platforms that operate entirely outside traditional banking. This isn't backward. It's what people do when they stop trusting their currency. Even in wealthier markets, gold is staging a quiet comeback. Singapore and the UAE are expanding gold-based banking. In Turkey, it's been used to coax savers back into the system. Gold is no longer just insurance. It's a bridge between the formal and informal economy. And in that trust equation, gold is winning. According to the World Gold Council, over 60% of people surveyed markets trust gold more than fiat. That includes developed countries. Of course, there are objections. Gold doesn't yield. Neither does cash when real interest rates are negative. At least gold isn't pretending. Gold is volatile. Sure, so is Bitcoin, which people seem to love for that very reason. Volatility is just the price of freedom. Gold is psychological. Well, of course, so is fiat. But one's lasted 5,000 years, and the other needs a press conference every 6 weeks just to keep it believable. And yes, you can buy Bitcoin. Just remember, if your asset depends on electricity and internet access, it's not a hedge against collapse. It's a bet on survival. Also, not all gold is created equal. If you're buying an ETF, you're buying a claim. If that ETF provider goes bust, your gold goes with them. Physical gold, owned outright, in your hand or in a vault, in your control, is the only real hedge. Everything else, just paper. And if you're buying gold to exit the system, isn't trust the very thing you're trying to leave behind? In the West, wealth is theoretical. It lives on spreadsheets, account balances, portfolios. It's managed, abstract, and invisible. Elsewhere, wealth is tangible. It clinks, it hides under mattresses, it gets passed down, not filed away. We call this unsophisticated, but when bank apps crash, cards decline, or inflation tears through so-called safe assets, it's the unsophisticated who come out with their wealth intact. The West trusts systems. The rest of the world trusts gold. And when systems fail, the outcome isn't theoretical, it's very real. So you ask yourself again, how much money do you really have? Not in stocks, not in forecasts, in actual, real wealth, untethered from someone else's spreadsheets. Gold doesn't care who you are. It doesn't care what you paid for it. It just sits there doing nothing while everything else slowly unravels. It has no CEO, no yield, no monetary policy. It's the only financial asset that requires no faith because it's backed by time, scarcity, and reality. This isn't about panic, it's about realism. You don't need to outsmart the system, you just need to stop trusting it. And what do I think? Well, you don't need to outsmart the system, you just need to stop trusting it. So why don't you tell us what you think? Hit subscribe, get involved in the conversation below, and let's keep it going.